Now that the Nvidia event is behind us, the market's focus is on the Fed decision tomorrow. And despite concerns about rates staying higher for longer, stocks posted gains on the day with the S&P 500 closing at a new all-time high. But our next guest says investors shouldn't be focused on AI or the Fed. The next true catalyst is earnings season, which is just a few weeks away here. Joining us now is Michael Antonelli, Baird Managing Director and Market Strategist. Michael, I do have to start on the markets, though. Listen, Mike, we end today, the Dow tacks on another 300 points here. The SPX notches a record close. Things seem pretty good. Where do you see the market headed here in the near to intermediate term?
I love that I got to follow my friend Miles. He's one of my guys. So I looked at my board up here, the number of times I've been on Yahoo Finance, and I've been at new all-time highs 3 times. So I'm counting myself as part of like the good membership of Yahoo Finance. I think the market is what it is, and we're overthinking this whole thing. We're totally overthinking this whole thing. Let's put the dot plot aside for a second. Let's put Nvidia and rockstar status aside for a second. Earnings are at their highest level in history. Earnings expectations 12-month forward are at 249. We are at all-time highs. Why? Because earnings keep going up. Earnings estimates keep going up. Can that change? Obviously, it can change. For sure, it can change. But we have a consumer with a solid balance sheet. We have earnings estimates going up. We have this AI theme. Things are good. We're overthinking this. Let's just focus on the fact that earnings season is the next catalyst, not the dot plot. I think it's not the dot plot, even though I agree with Miles. It's probably like 2 or 3.
Okay, Michael, I'm going to push back a little, though, because we do have inflation that is pretty high, and there have been stickier areas of inflation, like shelter, for example. And really, the housing issue seems to be an impossible scenario to navigate in some ways. How do you think the Fed should approach those areas that just don't seem to be coming down?
And that's it, right? We could look at CPI over the past 6 months. It's annualizing about 3%, but if you were to take out shelter, it's 1.8. I know that's kind of lazy to say take out something that actually everybody consumes, so I'm not going to play that role. Okay, yes, shelter is high. It's high for basically structural reasons. We don't have enough homes, and the places that need more apartments are slow to get new apartments. So we're in this kind of structural problem that the Fed can't solve. The government can't really solve it. We're in this demographic patch where millennials, all of you guys are buying so many homes. We don't have enough of them. So we're in these kind of structural situations that the Fed's going to have to just acknowledge and say, shelter's not coming down as fast as we thought, and there's really not that much we can do about it other than slamming the brakes on the economy. But again, how many people have a 3% mortgage out there? So many. So many. So you can't make those people move. It's kind of an intractable problem here.
No, listen, I get you, Michael. If I was locked in at 3%, I'd never be moving. Let me ask you, what bottom line do you expect to hear from the Fed tomorrow? And when do you think, Michael, they start easing?
They're going to have to push it out, but they can't push it out too far, right? They can't push out they can't push out the cuts towards the election. Then you're going to just start to drum up all sorts of unnecessary concerns about cutting around an election. So if they're going to guide, they're going to have to guide sometime a couple months before that election season really starts to ramp up. You know, we keep asking the Fed to cut, and they keep saying we're watching, and then the CPI comes out hot, and then they say we're watching. We're just keep doing this cycle. Will they cut? Won't they cut? Does the market care? I mean, if CPI is coming in hot and they keep pushing out cuts, why are we at all-time highs? Does the market just not see this? Clearly it does. I think, again, we're overlooking the simple answer here, which is that the economy's fine, the consumer's fine, and earnings are rising. The Fed is important, yes, but we're putting way too much importance on dot plots, and we need to start thinking about the stuff that actually matters to the market right now, and that's the thing I've mentioned about 6 times so far.
Mm-hmm. So then to that point, do you think there's any difference between 2 cuts versus 3 cuts, or even if we don't see any cuts this year?
I think the market will be fine with no cuts. I really do. I mean, I don't think the market needs cuts to go higher. Will that help? Yes, maybe if they say we're cutting soon, certainly I think the market will be up pretty big over the next few days. I don't know if this is a hot take, but I don't think the market needs cuts to keep going higher. As long as earnings and the consumers stay fine. Your previous guests were a little bearish for my taste, talking about a hard landing. I don't know what that's all about. But I think we're in the no landing category. There's no landing. We're off. We're just going. But I don't think the Fed. I don't think we need a rate cut for the market to go higher. I'm gonna stake that claim right now.
Michael, to your point, yeah, I don't remember the last time I had a hard landing guest on the show. So at least it was kind of refreshing.
Yeah.
It was something new. So Michael, as you look across the equity market right now, and just given the backdrop you've kind of laid out, what sectors look attractive to you, Michael? What would you find? Where do you see opportunity? And by the way, what also would you avoid?
I certainly tech is what it is. We talk about tech nonstop. I think the industrials and the consumer discretionary space, to me, are the most interesting. I think there's a lot of interesting, well-run companies in there in the consumer space. I do think housing is still a great Look at ITB. ITB, the housing ETF today, it's near its all-time highs. Some of the home builders back close to all-time highs. If the market was worried about rates or if the market was worried about inflation, why are these home builders still continuing to do well? There's a lot of industrial companies, a lot of financials, I think, that are doing well. We don't always have to talk about tech or Nvidia. That certainly that gets a lot of oxygen in the room, but I would probably stay away from some of the like consumer staples, some of the defensive names. I just don't think it's the right time to take up the defense. I think it's okay to continue to play what's working. And right now, industrials, financials, even tech, they're all doing really very, very well. And honestly, let me just throw out a stat. By the way, the market's up 8% through for the first 50 days. If it's been at least up 5% through the first 50 days, it's been positive 24 of 25 times. The only outlier is 1987. And that always shows up on all this stuff. 87 always shows up. But being up this much into the year is actually historically a really good sign.
What about the energy sector, Michael? That was a top performing sector today. We've seen commodities really ripping across the board. Are you bullish on energy in the long term?
I mean, I'm the kind of guy that thinks a bet on commodities is a bet against human innovation. So you might have the wrong guest on betting on commodities. I'd rather bet on new products and innovation. And certainly the energy sector has done well. We do have a kind of a perky crude oil up back above 80. I mean, energy does have a place, I think, in a portfolio, especially if you're looking to diversify. So I'm not going to say that I completely would avoid it. That's not the case. But I do think a big bet on energy is a bet against human innovation. And that's just not my brand. That's not my style, really. So I still like the financials and discretionary and industrials better.